Hey, hello, and welcome. Yet another episode of Going Elliptic, and I'm hoping that all the listeners who've been with us and come back to join us now are enjoying the content that we're putting out there. Today we have a slightly different take. We've been calling traders to our show. We've spoken to fund managers, and as promised, we want to get deeper into the crypto sort of technology and crypto economy space. And today we try the series, or rather start the series, which we like to call Protocol. And as Protocol, the idea really is to get into protocols and crypto economics and the underlying technology and the mechanics, and therefore also kind of rope in people who are more behind the scenes but doing all the interesting, deep work out there. So this is the very first one. Hope you like it. If you like it, definitely give us a thumbs up. Don't forget to subscribe. We've been putting out a lot of content, as you're aware. And then we're also in the process of bringing out newsletters and a bunch of other content. In fact, we'll do a Charted session tomorrow. So yes, subscribe so you know that it's coming. And, you can get all the content as soon as it's out there. So with that said, Paul, how are you doing?
Yeah, pretty good. It's been obviously Easter weekend, lots of family time, but yeah, I mean, crypto never sleeps. It's also interesting in the markets as well. We've seen a new all-time high, and yeah, it's just all around pretty exciting.
Truly, yeah, absolutely. Very eventful last couple of days with a lot of price action and a lot of things going on as always. Excellent. And who do we have today for Protocol?
Yeah, so today's actually ex-colleague of mine, and he made a pretty bold leap from a retail bank into just digging in at the protocol level when we were working together at Blockchain Labs, and yeah, has since gone on to do some pretty impressive kind of behind-the-scenes work for MakerDAO and a few others. So yeah, today we're talking with Will Remor, and yeah, it's going to be an interesting chat. How about I bring him in?
Let's do it.
Hello, guys. Hello, how are you guys doing?
Great. And yeah, thanks for joining us today, Will. I know it's also still end of your Easter weekend, so thanks for taking time out to talk to us.
Absolutely, happy to be here.
Excellent. Well, yeah, let's dive in. So, I mean, you've been working in DeFi for a few years now, and you've kind of seen it evolve quite a fair bit. Tell us about your journey and yeah, what's been fascinating and what's been frustrating through those few years there.
Yeah, absolutely, no problem. So I've started, of course, getting first my feet into the Ethereum network back in the days when I started actually working together. So in the early days, I was still working in retail banking, credit risk, and as part of like one of the portfolios that I actually managed there was around digital identity, actually interaction that I had with digital identity. And I had an opportunity through that work to get a little bit of exposure into the works that were going back in 2016, 2017 around like self-sovereign identity, and that's where I kind of really like learned about Ethereum, and started actually kind of engaging with the community around, especially like the local community in New Zealand, and then that opened up my mind to the breadth of work that was happening in the Ethereum ecosystem back in 2017. And my interest was, in the early days, I was not someone that got interested into this because of money. Actually, I didn't have like any investments in like Bitcoin or Ethereum or anything like this. It was purely tech. And then from there, I evolved to work with Blockchain Labs and smart contract auditing and advisory that Blockchain Labs was doing in that space, and actually interacting with a lot of projects that back in 2018, 2019 was actually very important actually to the ecosystem. then after that was basically I was in that kind of dilemma, kind of having come from a quantitative credit risk background. I was after gaining some of the experience with smart contracts, to say like actually what sits in that realm between risk and blockchain smart contracts, and I was like the only answer that I could get that it was actually a very serious project there was actually MakerDAO. And that's actually how I started actually getting involved with the maker community back in 2019. And of course, just the picture is much different now than it was then. But Maker is still a cornerstone, I think, still a cornerstone of the whole DeFi ecosystem. Since then, there's much more that has been built. But yeah, and that's kind
Absolutely.
of in a nutshell the journey. Yeah.
Totally, yeah. So in fact, talking about Maker, as you rightly pointed out, Will, Maker has been at the forefront, so to speak, of DeFi, and many others have sort of followed the lead of collateralizing assets and therefore sort of allowing for other rich financial transactions on top of it, whether it's lending markets or stable coins or what have you. So I think the one part that we definitely want to talk to you about and learn from you is how important has this whole aspect of collateralization been in the world of DeFi, and from your own inner workings with Maker and also looking at perhaps the ecosystem like Aave and others, what has played into these collateralization parameters and how are they evolving, right? Because although the time has been very short, there's been a lot of activity. So, over the last 12, 15 months and more, what have you seen and learned? So share with us, all the fantastic things around collateralization and parameters and, how to look at it.
Absolutely. No. So actually the work that we've been doing at Maker initially, it was, we had actually a team that was set up. There was just a couple of guys literally that were actually setting up the parameters for the whole of the ecosystem. Of course, Maker was a much smaller beast than that is right now. So the teams have actually grown a lot. In terms of the collateralization aspect of it and the parameters, we a lot of the initial kind of analysts that were working in this space came from a asset management background, and therefore, of course, utilized some of the common models that were used in that world. Not so much kind of credit risk focused models, but a lot of like a financial risk type of models. And the fact that the environment was so so volatile, and it still is for a lot of those collaterals, actually had to start actually thinking like from a first principle basis in terms of what are the characteristics of the assets that we are dealing with here. Initially,
Right.
It was only Ether really, right? So we didn't have actually to think too much about other assets, because when I joined the ecosystem was a single collateral DAI still. So we had a only view of let's try to understand ETH as an asset and how it actually evolves our market. But of course, our problems actually have evolved a lot from the single collateral DAI to the move to the multi-collateral DAI, and a lot of that actually transition has been quite like incremental and not taking like more risks that we could handle, because back then it was just again like three, four people working for the whole of the protocol, and therefore it started kind of complexifying the initial models, that the general model framework that actually was set up during like a whole like 9-10 months of intense work to now actually include more dynamic models, where actually we're actually setting up the whole monitoring parameters as we go and trying actually to adapt and dynamically adjust even like that setting parameters and collateralization ratios, and try actually to kind of like sometimes actually play a little bit more in the edge of some of the assets that we are dealing with, observing as well the ecosystem of other protocols and how actually they play. But I think makers are still significantly different from for example, other asset managers like Aave and Compound, because we kind of like we're issuing this product, we actually use the main product that is utilized, which is the generation of debt through the DAI to the end user. So yeah, so it has moved a lot actually over the last couple of years. That's for sure.
Yeah, and it's interesting because I mean, in the early days of Maker, and probably still around the time you joined, there was a lot of industry pundits who were just like, even with over collateralization, there'll be a sharp movement in the price of ETH, and DAI will unpeg. It's just not feasible. So obviously, to go from there to where you are now, where regardless of volatility, even some of those parameters, as you just explained, can be more dynamic, right? Do you feel like that kind of effort that's gone in over the 2 years now is what's going to be sustainable going forward in the crypto economic space, or will it need to keep adapting and changing to keep up?
I think so. There's a little bit of both. I think one of the characteristics of Maker is we kind of like have that sort of like a lint effect, which is Maker as being one of the longest standing protocols in this space. So therefore, I think there's a matter of like stability that needs to be kind of to be seen from a protocol versus actually other protocols that are probably more trying to obtain an edge in this highly competitive market that it is right now, that it wasn't like 2 years ago. Therefore, it needs to be seen as like a hub where people actually can trust that there will be a lot of documentation, a lot of actually governance process actually that comes into how we set new parameters for the protocol, and also a lot of certainty, because at the end of the day, has to a great extent over the last, especially over the last 6 months or so, Maker has moved on from being like a B2C market to being more and more kind of like a B2B market that is actually used by very big, holders of DAI, such as Nexo and other institutions. Let's say like this, like Fintech players in this space, which is fairly different from being oriented toward like the end user, where any end user could just like mint himself some DAI and go and trade into the market. Right now, it's becoming actually more and more kind of like a B2B market.
Yeah, that's an interesting point there that you make, Will. In fact, on that point, I think the question that pops up at me is really around the growth of stablecoins at large, right? And I think what we have seen since, I would say, 2017 and beyond, is that the stablecoins market has just increased and increased and increased. It's just been sort of a parabolic exponential curve. And lately, in the last sort of few months, as the bull cycle has started, it has only accelerated. So that curve has only become steeper, right? And so, would love to get your viewpoint. What's your take on the rise of stablecoins? And my personal view is that I think, Bitcoin was supposed to be one of the things was a form of payment, which I think it's probably is not going to become one, right? That's definitely not happening, but Stable coins are the ones that have become a form of payment or a form of transaction because they are stable. So that's at least my 2 cents there. But I want to hear from an expert like you what you think about stable coin, rise of stable coin. Where do you see it going? So yeah, tell us some about that.
I think they would. I mean, as you see, but like the nature of stable coins is that now the market has become quite, I guess, already fragmented between like the different stable coins with a clear distinctions between the custodial type of stablecoin like USDC and Tether versus like collateral based stablecoins like DAI, and there has been a few other attempts, even like forks of the maker protocol, and then the algorithm based stablecoins, which are still quite I guess untested ground at this stage, but have been a few attempts with Reserve and basis back in the days, and then of course the commodity type of like stablecoins, but that's probably not as big in terms of like market size. So you've got I think these two main types of actual stablecoins, which the custodial and the crypto collateral based stablecoin, and I think at this stage we're seeing the custodial stablecoins actually being probably going to evolve to an extent actually faster, and it's already actually evolving faster with that market of like end user, because actually he has created some mechanisms to kind of like create like a sort of like a federated model where they can get access to different financially regulated institutions that actually are minters in that ecosystem. So actually we'll keep it, I guess that will get some traction with end users because it will make it easier for that all rent to them. But at the back of that, there's still you can only go as far with that kind of model as you grow that ecosystem of minters, and you actually then get people to utilize Visa for payments and PayPal and such of those fintechs. But on the other side, you still have a mechanism that actually sets the interest rates and the yield curves and things like that. That is basically the kind of like what Maker does for the ecosystem.
Right.
Because then you're working on things that actually go beyond just an issuance of debt, but actually you start actually playing the yield curve market and the bond market, and those markets actually really drive the increase of debt, and that actually drives growth in the economy, right? And then you start actually having other interest rating markets that actually want to provide for example, users some stability with like fixed rates, and they will have to use some basis for what is actually the mechanism of the floating rates in those markets. And that's where I think Maker will likely play a lot of that role, being that wholesale market for setting wholesale interest rates, along with other protocols. Of course, we're not going to be the only one. But that's the direction actually I'm seeing at the moment. And that picture might evolve over the next year or so. DeFi is so fast that it's hard to have like a crystal ball around that.
Yeah, that's true. And that's very interesting take there, that both you see this as sort of a step towards institutionalization, but you also see this towards evolution, right? That we have seen the first level of products where there's basic collateralization and retail level sort of lending, but now you're saying, well, this could become like a big debt and credit market. In some sense, this is a debt credit market 2.0, right? With sort of automated and algorithmic way of looking at it. So I think that's very fascinating. The other part, Will, that I want to dig into is, we've heard this, of course, from what all these sort of DeFi ecosystem is trying to do, and certainly Maker seems to also be sort of cooking that up, is where they're looking at real world assets, right? Where the idea is, this is great that we've got a flourishing crypto ecosystem, but there is so much of assets which are just locked in and illiquid out there, and they could perhaps be brought to the blockchain and you could do the same mechanism, right? Collateralize it and then kind of set them free, if you may, or make them liquid. So I would love to hear from you how you view that, and tell us a little bit more of what's the approach. How do you see that evolving? What do you see is going to work? Where your fears are in terms of real world assets coming on board? So yeah, tell us some about it. Yeah.
No problem. So this is actually at the core of what I'm actually doing at Maker at the moment. So I evolved from actually working with like crypto native assets into being a part of the foundation team that is playing, let's say, like this with real world assets. That has been I guess, something that is long standing in the mindsets of the creators of Maker to one day actually allow this protocol to finance the financiers in the real world. That's what actually we're really talking about, just to define what the problem here, what it is. And that brings a relatively actually big set of challenges. It's quite different dealing with like a trustless mechanisms for setting parameters or bringing new assets into the protocol. When you're talking about crypto native, you don't have to trust any sort of counterparty as long as the assets and the smart contracts actually to define that counterparty in the crypto native world are there, and you've got like your smart contract auditors and all that kind of stuff, and you can see everything that is actually happening. When you bring real world assets into the picture, you've got to deal with challenges that are around, as you're saying before, about liquidity of those assets. But you also have to deal with a whole set of mostly operational risks, right? Because you're dealing with actually real counterparties, real lenders that are acting in the real world, that are financing real borrowers, and then you move from dealing only with valuation models. You bring a lot of other types of risks: operational risk, credit risk, market risk. It's much broader in scope compared to crypto native assets, where you're actually mostly dealing, what you're defining there is actually market risk. As soon as you're pricing movement crypto native assets, you have to set up the parameters according to that market risk, and you should, for most cases, actually define when you're going to into real world assets. It's a bigger set of risks that you have actually to cover, and the operational risk is definitely one of the biggest ones, because you need actually you bring those aspects around AML, KYC, and how reliable and trustworthy the counterparty is, and all those things. And there's a lot of regulation for those things, so it depends on which jurisdiction you're dealing with. You have actually to have those grounds covered as well. But again, I mean, we're in the very early days of this bridge, let's say, that we're building with the real assets, and it's been actually super exciting. We're dealing with some counterparties that are across a set of let's say industries. So you're able to manage I guess portfolio with a wider view, and with like assets that are much less correlated to each other than all crypto assets, right? So you're not dealing with your 0.8 plus correlation. You're really kind of you start actually move the protocol into a more mature point of view, but that comes with a lot of challenges. So we actually there's a lot of friction actually to cover as you evolve, and that's where you actually mostly dealing with at the moment, actually dealing with how to remove the friction or reduce the friction, and clearly define what is the scope and what are the objectives that we have over the next 6-12 months and so on. But yeah, I think if I had a crystal ball, I would say one of the greatest aspects of this, and this is not relevant only for crypto, it's gonna be the liquidity that this might be injection into some illiquid markets, and that's something that has been a struggle even like on traditional finance for a long while, how to bring, for example, liquidity to the bond market, right? And this is probably, I think, the next frontier that we're going to see as well in the traditional financial world. That's actually something that is being worked on as we speak, and I think that's where the fintechs, the non-crypto fintechs, actually are going to be focusing on the next 10 years. If I had a crystal ball, that's what I would bet on. It's bringing the liquidity that we've seen in the equity market over the last 10 years with like places like, Robinhood and Betterment and so on. Fintechs actually moving into the liquidity of the bond market.
That's really interesting because obviously we kind of perceive that crypto is moving at this, really rapid pace and evolving quite quickly. But then it seems like what you're saying there with your prediction is once the cat's out of the bag and we actually bring liquidity to a liquid real world assets, we're going to see another explosion, right? It's going to be completely eclipse what we've seen so far. Is that in line with your prediction?
I would say it's more like we're probably going to be playing a part in that, yeah. And I think that's where probably like crypto and some of the traditional fintechs will start actually kind of like to merge in a way, because they might actually be chasing the same thing, which is how can we make actually the debt markets more liquid, and potentially less only driven to institutions, because that's what actually debt markets they actually are right now. They are mostly a market for institutions where actually you only see your exposure to those markets through, say, your pension funds and things like that. But you cannot, for most people, they don't go off there on their own and buy fixed income assets, right? So that's
Sure.
and manage those portfolios the same way that they manage, for example, their share portfolio or their crypto portfolio. And that's probably, I think, the frontier that we're going to see. And there will be fintechs and crypto both playing in that industry, and the industry is huge. So I think there's lots of work to be done in that space.
Yeah, and so one of your tweets in this past week was also kind of predicting at what point do we kind of see those economies maybe merging and having one umbrella that is, aspects of the real world economy and the crypto economy under the same roof, if you like. You're pretty bullish we'll see that within the next decade?
I think we're going to see a lot of hints of what that will look like over the next 5 years or so. Don't have a crystal ball, but I think the market is very big, and in my view, it's going to be tackling the thing with crypto is that you've got different projects working on different aspects of the different markets, interest markets, debt markets, derivatives markets. So you're going to probably see a lot of those different projects working in parallel, and we may not figure out what the end picture will look like up until quite a few steps down the track, where then you're going to see that, I guess, some sort of like integration between those different markets. That's how I see it. And at the moment, I just think there will be a lot of ant work, like really little ant work to be done on the debt market, and then we might move on to those other markets that the post that I actually sent out this week, which covers also like the derivative market, which is huge. And the derivatives market is probably the one that I think that will take some time because it's because the size of it, and and the industries that actually will cover. So we're going to have actually to evolve on the like the debt markets quite a lot for us to start actually seeing, people setting up like call and put options on debt markets, because it's inherently a little bit less, I guess, trustless. So therefore, there will need to be built trust first into those players that are working on the debt markets before people actually going on and also betting their money on the derivatives markets. At least that's how I see that. But let's see. Time will tell.
Yep.
I guess.
And yeah, we got one question through on the chat from one of the listeners tuned in, so I'll just bring that up. And it touches on your point there about how there will need to be kind of further specialization or cooperation between different DeFi protocols. And here they're asking, how would MakerDAO, say, react to a new player like Terra?
Challenging one. I think my take on it is right now is that most of the specialization, and even like I would say like the risk setting that is happening in the DeFi ecosystem is on specific verticals of the protocols where people actually are working. There's relatively little activity where we measure systemic risks cross protocols, right? There's a few teams actually working on these aspects, but it's still very, very incipient, and I would say even like to an extent immature. There will be, I think, will as an industry have the specialization of people that will look at actually systemic risk the same way that some banking actors, I guess, in the traditional world, look at systemic risk across the different actually economies that actually are covered. But at the moment, it is mostly like per protocol. People are setting parameters and actually having some look across different protocols, but not so much as I think would be probably ideal for us to build a robust industry.
That's a really good take on it there. So thanks for that, Will. All right. So yeah, as a reminder to everyone that's tuned in, this is purely educational content, no investment advice from either us or from Will, but we do really love those feedback kind of mechanisms. So people dropping in comments, giving us a like, and hopefully also subscribe. So Will, before you go, we want to also hit you with a rapid fire kind of 5 questions there. It's a little bit more fun and fast. Are you ready?
Yeah, sure.
This is the funnest one. Let's go.
Yeah. So if you had to choose one of these areas to analyze, would it be lending markets, yield farming, or DeFi futures?
DeFi futures sounds like an appealing one to do.
Very cool. Okay. In one sentence, what's possible now in 2021 that wasn't possible when you got into crypto in 2017?
Oh my God. So much. I would say what was possible in 2017 that it was actually possible in 2021. I would say it's probably the way that I would phrase it. No, yeah, it's miles apart from each other. I don't know. Trading the futures markets, for example, it wasn't actually possible back then.
True. All right, third one. In your opinion, what's the single biggest use case for crypto? And you can't say stablecoins.
No, I think right now, comparing to 2017, crypto is really focusing on rebuilding finance. So I think the use case is actually building the different blocks of finance. It's the first use case, and we will see some of the use cases that we had back in the ICO times, probably down the road when these building blocks are in place, I think.
Great. And then quickly complete the sentence. DeFi makes
the world better.
Nice.
Good one.
Okay. And lastly, if you had 60 seconds, what would you tell somebody who's looking at switching from traditional finance to DeFi for their primary work?
Wow, this is a challenging one, but I would probably get them to try to understand how money is created. That is actually the very first question that I would ask them. I would ask them to say, do go through that rabbit hole, and if you can actually answer that question, then I think you, even on a traditional finance, really actually understand what is it that you're doing. I've been trying to do this for years now, talking to actually ex-credit risk colleagues that I had back in banking, and haven't been hugely successful into bringing them into this world yet. So, but yeah, that's the question I would ask.
Excellent. Well, that's been a lot of fun there, Will, and a lot of great content for our listeners to digest as well.
Yeah, fantastic. We learned a lot. I think your perspective on DeFi, on collateralization, on looking at how the market is evolving, and just so many other factors was really fun. It was good.
Awesome. Yeah, happy to be here. You can let your listeners that are actually interested in all the aspects of lending markets for the sake of like real world assets, that are interested in actually getting any exposure into this space, that are curious about it, just to reach out anytime through Twitter or LinkedIn or any of your channels that I'm out there, and happy to actually introduce anyone into this brave new world.
Awesome. And yeah, we'll include your Twitter handle there in the show notes.
Right. Awesome, guys. Yeah.
All right. Thanks for joining us, Will. We'll let you go now.
Thank you.
Cool. Thank you. Thank you, Paul. Thank you, Chenki.
Excellent. So with that said, I think just a couple of pieces, educational content, as Paul, you already reminded our listeners. And then I think the other part, of course, is that there's a lot more coming. We'll do a chartered session tomorrow. I think we're getting a newsletter out as well.
Yep, second newsletter out. Should also be tomorrow, so that'll be great.
Exactly, yeah. And I think this time we're thinking we'll cover some more of the DeFi stuff, which I think people liked. That has been the theme. That's on a lot of people's minds. So hopefully people get some good content there that would help them understand the space better. Excellent. So I think, yeah, another great session. Was a good one, great content as we promised.
Yeah, thanks for that as well, Shanky. And I hope everyone's had a really good Easter break and is ready for what the week ahead holds in crypto.
Perfect.
Great. See you next time.
Next time, guys, on that note, keep going elective.